Tonight, our FM class, we shall be discussing capital structure and theories of gearing. I'm aware that this class started on Monday with the first lecturer, Mr. Adejuwon. Adejuwon is taking you cost of capital. I will be taking you capital structure and theories of gearing. Let me quickly say that there's relationship between this topic and cost of capital calculation. There's relationship between capital structure and cost of capital computation. All right. Yeah, Mr. Irabo.
Good evening, sir.
Yeah, good evening.
Yes, it seems you're a bit far from your mic. I don't know if I'm the only one, but it's as if a bit far from your mic also.
I'm not far from my system. So please, somebody confirm. Can you hear me clearly?
Yes, sir. Yes, sir.
Yes, sir.
So, Mr. Irabo, go and check your device. I'm not far from my system at all. All right. Let us move straight to the business. I want to believe that the first lecturer must have done an overview of financial management. But let me do small introduction. When you say financial management, it's an aspect of management that focuses on the financial affairs of the business. It's a major aspect of management. It's an integral part of management that focuses on the financial aspects of the business. It considers different types of financing. How can companies source finance? How can companies utilize finance so as to meet the objective of the business entity? If you cannot hear me, it is your device, not my device. So I will ask again. Please confirm you can hear me clearly.
Yes, sir. We can hear you clearly.
So please, if you're having problem hearing me, just go and resolve your personal problem with your device. All right. So financial management is about how you can raise capital to finance the business so as to achieve the objective of a business entity. All right. Having said that, Let us look at the topic tonight. Capital structure and theories of gearing. Number one, what is capital? What do you understand by capital? We can define capital as money used to create a business, to build a business, and to run a business. Capital is the money used to create, to build, and to run a business. If you want to start a business, you require capital to start your business. If you want to expand your business, you require capital to build your business. And to run your business on a daily basis, we require capital. So capital is the money used to create a business, to build a business, and to run a business. Number two, types of capital. Basically, there are two types of capital: equity capital and debt capital. Basically, there are two types of capital. We have the equity capital and we have the debt capital. Equity capital is the capital contributed to the business by the owners of the business. Equity capital, money contributed to the business by the owners of the business. The owners of the business are the shareholders. Therefore, equity capital represents money contributed to the business by the shareholders. Number two, debt capital. Your debt capital refers to borrowed fund. Debt capital represents all forms of borrowing to the business. You can finance your business by borrowing, or you can finance your business by using your personal money. Your personal money is your equity. The amount you borrowed to finance your business will be classified as debt capital. Excuse me, please. We have explained what is capital. We have explained types of capital. Next, what is capital structure? What is capital structure? Capital structure is the mixture of equity and debt capital used by a company to finance its activities. All right, let's go on with the class. Your capital structure. Your capital structure is the mix of equity and debt capital used by a company to finance its activities. Your capital structure or capital structure refers to the different types of capital a company uses to finance its activities. I'll take that again. The capital structure. The capital structure of a company, otherwise known as financial structure, shows the different types of capital a company uses to finance its activities. This may include ordinary share capital, preference share capital, and long-term borrowings in the form of debentures. The capital structure, otherwise known as financial structure, can include the ordinary share capital, preference share capital, long-term borrowings in the form of debentures, bond, loan notes, loan stock. So in summary, your capital structure shows the various types of capital a company uses to fund or to finance its activities. In summary, a company or a business may be financed by equity capital or debt capital, or a combination of equity and debt capital. Business may be financed by equity capital or debt capital, or a combination of equity and debt capital. If a company is financed by equity capital only, such company will be classified as ungeared company. Look at it here. Ungeared. If a company is financed by equity capital only, such company will be classified as ungeared company. If a company is financed by a mixture of equity and debt capital, such company will be classified as geared company. So please note, a company may be geared or ungeared. If you finance your business with your own money only, your own equity contribution, then your business will be classified as ungeared company. If you finance your business with both equity and debt capital, then your business will be classified as geared company. All right? We have defined what is capital. We have explained types of capital. We have explained capital structure. We explained geared and ungeared. Our next explanation, risk. What is risk? Question from Ahmed. If a company is fully financed by debt, how do we classify the company? Please note, in reality, no company is financed by debt 100%. In practice, no, please, not highly geared. In practice, you cannot see a company financed by debt 100%. Nobody will give you that money. You want to start your business. You are not contributing any money to the business. You now want people to borrow you money. That means you are not the owners of the business. You are just managing the business for the owner. So please note, there is no situation where a company will be financed by debt 100%. All right, thank you for the question. Now, what is risk? Why do we need to understand risk? How you finance your business can either increase your risk or reduce your risk. Your capital structure decision, the choice of your capital structure can increase your risk or reduce your risk. Now, what is risk? Risk is the variability in returns. Risk is the variability in returns. We can also define risk as volatility in returns. The higher the variability, the higher the risk. When you say risk, it's a situation where your return is unstable. When you say risk, a situation where your investment return, your investment value is fluctuating. Your investment value is changing. In that case, we said the investment is risky. Business risk. You can classify risk into two. Risk can be classified into two. You have the business risk and you have the financial risk. Business risk. This is the variability in the firm's operating profits. Your business risk. This is the variability in the firm's operating income. That is income before income before interest and tax. The business risk is the risk that a company may achieve low profits, or the company may sustain losses as a result of the nature of the company's business. I will take that again. The business risk. The risk that a company may achieve a very low profit, or the company may incur loss as a result of the nature of the company's business. Business risk is associated with the nature of the business. It is the risk that the investor may achieve low return. It is the risk that the investor may achieve low return as a result of the nature of the business and the industry sector in which the business operates. In summary, when you say business risk, risk that has to do with the nature of your business, the risk that you might not achieve profit because of the nature of your business. Please note, every business has its own risk. Please note, every business has its own business risk. If you are talking of banking business, we have banking business risk. If you are talking of telecommunication business, we have telecommunication business risk. If you are talking of construction business, we have construction business risk. All right. Number 2, financial risk. Your financial risk is the additional variability in returns to the shareholders. Financial risk. Financial risk is additional variability in returns to the shareholders. Financial risk is additional variability in returns to the shareholders that arises because there's debt capital in the company's capital structure that arises because there's debt capital in the company's capital structure. In other words, financial risk is purely associated with debt capital. In other words, financial risk is purely associated with debt capital. Financial risk will only happen Financial risk will only arise when a company borrows money. Please note this. Financial risk will only arise if a company borrows money. Note, where a company is financed by equity capital only. Where a company is financed by equity capital only, the financial risk will be zero. All right. For those looking for the page, what you don't need to do is to save yourself. You have the contents of the material. Just go to the content. There's certain things that you don't wait for anybody to tell you. Just look at the content and move to the page. If you're interested in looking at, just go to that page. Excuse me. All right. We have explained what is risk, classification of risk. All right, yeah. Chibuzo, your question, please unmute.
Okay, sir. I wanted to reconfirm what you said last by mentioning that where a company is financed with equity capital only, right? Is it equity capital only?
Yes.
Okay, then the financial risk is zero.
Yeah. Look at it here. It's in the notes. That's correct. When you finance your business with equity capital only, then your financial risk is zero. In as much as you have not borrowed money, then you don't have financial risk. We are only going to talk of financial risk because the company has borrowed money. All right. Abiola.
Sir, good evening, sir. So I want to ask, is the business risks and the financial risks, is there anything, what's the difference between the systematic business risks and the unsystematic? Are we still going to that? Or are we getting it here, sir?
Okay. Let me try to figure out what you are trying to ask.
Yes, sir.
That we still have systematic risk and unsystematic risk. Is that not?
Yes, sir.
Yes.
Systematic business risk and unsystematic financial risk. Are they the same thing with the risks you are talking about? Business risk and
Just calm
financial
down so
risk.
that you don't mix everything up. Is that clear? Now, when you get to portfolio theory, you are going to get to a topic of portfolio theory. You now have systematic risk, unsystematic risk. Under the systematic risk, you can have systematic business risk. You can have systematic financial risk. Under the unsystematic risk, You can have unsystematic business risk. You can have unsystematic financial risk. But what is systematic and unsystematic? Why do I remove it is because we are still going to get to it under portfolio. When you say systematic risk that cannot be avoided. When you say systematic risk, the risk that you cannot avoid. Once you invest your money, you are exposed to that risk. For example, inflation. Where there's inflation in an economy, if you like, invest your money in the banking sector or invest your money in telecommunication. Inflation will affect everybody. We now have unsystematic risk. These are risks that can be avoided. These are risks that can be reduced. Now, your unsystematic risk can be divided into business risk and financial risk. So, for the purpose of capital structure, you are going to look at risk as either business risk or financial risk. When you get to portfolio theory, you are not going to look at risk from systematic risk and unsystematic risk. So you are still coming to it. Is that better, Biola?
Yes, sir. Thank you, sir. Thank you, sir.
So you can raise your hand down now. Our next discussion, gearing. What is the meaning of gearing? It's also called leverage. When you say gearing is the proportion of debt capital to equity capital. Your gearing ratio, it is the extent to which a company has borrowed money. Gearing measures the extent to which a company has borrowed money to finance its business. Gearing measures the extent to which a company has borrowed money to finance its business. So your gearing is the ratio of debt capital to equity capital. Your gearing can also be measured as the ratio of long-term debt to shareholders' fund. You can also look at gearing as percentage of debt capital in the company's capital structure. If the debt capital is more, if the company has borrowed more money, where a company is financed by more borrowed fund, such company will be classified as highly geared.
Hello, sir. Please, can you recap regarding the ratio, sir? How it can be measured, sir?
What am I recapping now?
How the gearing can be measured in ratio form?
We are still coming to calculation now.
Okay, no, you mentioned some things about that. That's what I'm trying to say.
All right, please mute, because I mentioned so many things. I said your gearing. It measures ratio of debt capital to equity capital. That is one. I also said it measures the ratio of long-term debt to shareholders' fund. I also said gearing. It measures the extent to which a company is financed by debt. Capital in the company's capital structure. The percentage of debt capital in the company's capital structure. We are still coming to measurements. And I said, if a company borrows too much money, if your level of debt is more than equity, in that case, the company will be classified as highly geared. If your level of debt is greater than amount of equity, such company will be classified as highly geared. If your level of debt is lower than equity, such company may be classified as lowly geared. There are two types of gearing. There are two types of gearing. We have financial gearing and you have operating gearing. There are two types of gearing. You have the financial gearing and you have the operating gearing. Financial gearing is used to measure the amount of financial risk, the level of financial risk. I'll take that again. There are two types of gearing. You have the financial gearing and you have the operating gearing. Your financial gearing is used to measure the level of financial risk. Your financial gearing is used to measure the level of financial risk. Financial gearing measures relationship between long-term debt and shareholders' fund. Financial gearing measures relationship between long-term debt and shareholders' fund. It is used to measure the level of financial risk. Financial gearing indicates the extent to which the company's activities are funded by borrowed funds. Financial gearing indicates the degree or the extent to which the company's activities are funded by borrowed funds. It shows the extent to which a company has borrowed money. Please note, financial gearing can be calculated using the book value approach or the market value approach. Please note, financial gearing can be calculated using book value approach, or you can calculate using market value approach. Your book value approach is also called statements of financial position value approach. If you are to calculate financial gearing using excuse me, book value approach, you can calculate as book value of long-term debt divided by equity capital, including reserves. You calculate in percentage, please. We are going to pick the long-term debt in your balance sheet divided by the equity capital. The equity capital will include reserves. That is what we call shareholders fund. Share capital plus reserves. You can use this to calculate your financial gearing. Or you can use your financial gearing in percentage, please. Is equal to book value of long-term debt over equity value plus book value of long-term debt. Either of these methods can be used to calculate financial gearing using the book value approach. When we say book value, that is the balance sheet value. That is statement of financial position value. That is the value as stated in your balance sheets. It's called the book value. What are the advantages and disadvantages of book value approach, book value gearing? Limitations or weaknesses. It's an outdated valuation. Book value, historical cost, do not reflect current market valuation of the equity or debt. That is, our book value gearing is outdated valuation. This method does not reflect current market valuations of equity or debt. Hence, it may misrepresent the true leverage. This is a limitation. It may misrepresent the true leverage. Number 2 limitation. It ignores the book value approach, ignores market expectation. Book value gearing. Excuse me, please. Please excuse me. Book value gearing does not capture investors' perception or risk. Which affects cost of capital. These are the limitations of book value gearing. What are the benefits? Book value gearing is very simple to calculate. And is consistent with accounting standards. The book value approach is simple and consistent with accounting standards. It is easy to calculate from financial statements and consistent with regulatory text. These are the benefits of book value gearing. If you check November diets 2025, this question was texted. Examiner says, calculate financial gearing using the book value approach and the market value approach, stating the limitation and benefits of each method. This was texted for 20 marks. Right? Market value approach. Financial gearing based on market value approach. You can calculate as market value of long-term debt divided by the market value of equity. You can calculate as market value of long-term debt over market value of equity. Or you can use market value of long-term debt over market value of equity plus market value of long-term debt. Please note, preference shares is calculated as part of debt capital. Please note, preference shares is classified as part of debt, long debt. All right. What are the benefits of market value gearing? It reflects, market value gearing reflects economic reality. Market values incorporate current investors' expectations, current share price, and debt price. Hence, the book value approach is likely to give a more accurate view of the firm's economic leverage. The market value gearing is likely to produce a more accurate view of the firm's economic leverage. That is the firm's economic gearing and cost of capital. However, it has some limitation. Market value gearing is exposed to fluctuation or volatility. One of the limitations of market value approach is that this method is vulnerable to fluctuation in share price, volatility in share price. Number two, market distortion on small or illiquid stock. That is, where a company shares are thinly traded. That is, the shares are inactive. It's not actively traded at the stock market. The market value calculation may be unrepresentative. These are some of the limitations of market value gearing. So please, in summary, if you are to calculate financial gearing, you may be asked to calculate using value approach or using market value approach. But please note, financial gearing should be calculated using market value approach, unless the examiner states otherwise. Financial gearing should be calculated using the market value approach, unless the examiner states otherwise. All right. Don't forget, financial gearing is used to measure financial risk. Okay, I saw the chart, but I'm just trying not to get distracted. First is that the material, this just has some addition to explain. The material I have here, there are some additions that is added to further explain. Usually at the end of the class, the materials will still be shared with the class. So I just try not to be distracted with that charts. Majorly, when you are in class, I actually prefer the student to listen. You can get the material to read later, but I prefer when you listen. All right. Significance of financial gearing. Why is it important for shareholders, companies, financial analysts to understand financial gearing? What is the significance of financial gearing? Financial gearing is an attempt to quantify the degree of risk involved in holding equity shares in a company. Financial gearing is used to quantify the degree of risk involved in holding equity shares in a company. It measures the ability of a company to continue in business. It measures the ability of a company to remain in business and to be able to make returns to the investors. It measures the ability of a company to remain in business and in terms of ability of the company to pay dividend to the shareholders. Financial gearing measures the solvency ratio of a company. The more geared the company is, the greater the risk that little will be distributed to the shareholders. That is, if a company borrow money too much, there is a greater risk that the company may not have enough profit to pay the shareholders as dividends. This is because the company will pay interest to the debt holder. The company will pay preference dividends. Regardless of the level of the company's profit, company must pay interest. Company must pay preference dividends. A high financial gearing means that the company is more vulnerable to poor trading conditions. What are we trying to say is that financial gearing measures the ability of a company to continue in business. It also measures the ability of a company to be able to pay returns to the owners of the company. Where there's Volatility in earnings. Where there is volatility in earnings to the shareholder, there will be greater volatility in dividend paid. When the company is highly geared, the inability to pay returns to the investor is the main financial gearing. That is the main financial risk. When a company borrowed money too much, the company may not have sufficient income to pay the owners, the investors, the shareholders. This is the major financial risk to the shareholders. In summary, companies must monitor the level of financial gearing. Company must know when to stop borrowing money. All right. We have explained financial gearing. We have explained the calculation. We also explained the significance. Next is operating gearing. You can also call it operational gearing. Operating gearing is used to measure the level of business risk. Remember, financial gearing is used to measure the level of financial risk. When you get to operating gearing or operational gearing is used to measure the level of business risk. What is business risk? Recall, this is the risk of making a low profit or incur losses due to the nature of the company's business. Due to the nature of the business the company is involved in. Operating gearing is used to measure business risk. To calculate operating gearing, you can use contribution divided by profit before interest and tax. You can use contribution over profit before interest and tax. Your operating gearing measures relationship between contribution and earnings before interest and tax. You can also calculate operating gearing it should be here. Yes, there. You can calculate your operating gearing as fixed cost divided by total cost. Your fixed cost divided by the total cost. or you can calculate as. Any of the three methods can be used. You can use fixed cost over variable cost. Excuse me, please. All right. Let's do a recap of what we have done so far. We explain what is capital, types of capital, capital structure. We explain gearing. We explain business risk. We explain risk, business risk, financial risk. We now look at gearing. We explain gearing, financial gearing, operating gearing. Our next explanation. Factors affecting capital structure. What are the factors? Factors affect the choice of capital structure. What are the factors that can determine the choice of a company capital structure? What are we trying to discuss here? Should I finance my business with equity? Or should I finance my business with debt? Or should I finance with a combination of equity and debt? And in what proportion? What are the factors that can determine the choice of a company capital structure? This was texted November 9th for 20 marks. Number one factor. Nature of your business. Nature of the business. For capital intensive business, like oil and gas business, like aviation business, such company will require both the debt capital and equity capital. Such companies will require more of debt capital. Look at aviation business, airline business. Such businesses is capital intensive. They borrow a lot of money to run the business. So nature of your business will affect the choice of your capital structure. Number two, size of the business. The size of your business will also determine the choice of your capital structure. For large businesses, large businesses, multinational companies. They can easily borrow money. They can easily get debt finance at a reduced cost. In most cases, large companies finance their business with borrowings. Look at the like of Dangote. Dangote hardly uses money to finance his business. Lenders are willing to provide loan for Dangote business. Banks are willing to provide loans at a reduced rate. So the size of your company can determine the choice of your capital structure. Number 3 factor, earnings stability. Meaning that when a company has stable income, when a company generates stable earnings, such company can afford to borrow more money. If your business generates stable income, like telecommunication business, just look at telecommunication. Whether we like it or not, we buy data, we buy airtime on a daily basis. Such businesses have stable income. They generate income on a second basis. Such company can afford to borrow more money in their capital structure. But businesses with volatile earnings, unpredictable earnings, such business will stick to equity finance. Earnings that cannot be predicted. Such businesses will rely on equity finance. So in other words, any stability can affect the choice of capital structure. Number 4, growth rates. High growth companies require a lot of capital fast. Where a company is experiencing growth, such company will require more capital, which can easily be obtained through debt financing. So the growth rate affects its choice of capital. Number 5 factor, cost of capital. That is cost of fund. Let me take that again. The cost of fund. Debt capital is cheaper. The cost of debt capital is cheaper than the cost of equity capital. Because of tax advantage, Debt capital will give rise to tax relief. The tax relief can be used to reduce the cost of capital. So it's cheaper to finance your business with debt capital. If you are looking at cost, a company will use more of debt capital. If you are looking at cost, company will prefer debt capital because it's cheaper than equity capital. Number 6, cash flow position. A company with strong, predictable cash flow, strong and reliable cash flow supports higher debt, meaning that if you have a stable cash flow, if you have a strong cash flow, you can easily borrow money to finance your business. If your cash flow is predictable and reliable, such company can use debt finance in its capital structure. Number 7, asset structure. The structure of your asset, meaning, do you have tangible assets or intangible assets? Firms with tangible assets, such as plants, machinery, buildings, properties. Such company can easily borrow money. The tangible assets can be used as collateral to obtain loan. But service firm with few assets, service firm with intangible assets, rely more on equity finance. So your asset structure can determine the choice of your capital structure. Number 8 reason, interest rates. If interest rate is low, companies are likely to borrow more. But if the interest rate is high, company will rely on equity finance. So the interest rates will have impact on the choice of capital structure. Number 9 reason, capital market conditions. What is capital market? A market for long-term loan. Assuming you are asked, differentiate between money market and capital markets. You know, certain things, it's assumed that you have that knowledge. What is money market? A market for short-term loan. Money market is that market where you can borrow or lend on a short-term basis. All commercial banks operate in the money market. Commercial banks are designed to provide short-term loans. What is capital market? Capital market is the market for long-term capital. At this market, we have the stock market and we have the debt market. Under the capital market, you have the stock market. The stock market is the market for buying, selling of shares. This is the market where we trade in equity. The debt market is the market where we trade in long-term debt instruments. Please, guys, it is assumed that to be at this level, skills, you have some level of knowledge. All right, number 9 conditions that can affect your choice of capital structure is capital market conditions. If the stock market is booming, company can issue more shares so as to source finance. Number 10 reasons, inflation. High inflation reduces debt value. In an inflationary period, value of debt is eroded. So firm may borrow more, but lenders are likely to charge higher rates. So inflation, your choice of capital structure. Control, number 11 factor. We call it ownership and control factor. If you are trying to avoid dilution, if you are trying to avoid dilution in ownership and control, the company will use more of debt capital. To prevent dilution in ownership and control, company relies on debt capital. Owners who want to keep control prefer debt capital. Number 12, financial risk level. Don't forget, although debt capital is cheaper, it introduces to the business financial risk. This financial risk can lead to bankruptcy. So management will balance risk and return. Management must versus the return. So you have to look at the level of risk. The level of financial risk. Your level of financial gearing can affect your choice of capital structure. If the financial risk is too high, then the company will not be willing to take more debt. If the financial gearing is high, the company will be unwilling to take more debt finance. Lenders will not be willing to provide loans to the business. If a company borrows money too much, ability, the company should exercise caution with borrowing. Borrowing should be kept for emergency purposes. Some borrowing capacity should be maintained for emergency period. To round up this, we have tax policy. The tax policy operating in the country can affect the choice of capital structure. Where the tax rate is high, it favors debt finance. Lastly is legal or industry requirements. Legal or industry requirements. For some company, the law regulates the amount of capital to use. If you look at banking companies, laws specify the amount of equity and debt the bank should use. So for some company, law regulates the capital structure. For some company, industry regulate the capital structure. So industry requirements, legal requirements can affect the choice of capital structure. Right. Please, as much as possible, you are going to read these. Go and check November diets. Examiner texted factors affecting the choice of capital structure, 20 marks. To round up the discussion tonight, to round up our discussion tonight, we shall look at theories of capital structure. To round up our discussion tonight, we shall look at the theories of capital structure. What are we trying to discuss here? The question we are trying to unravel here. Do you think, let me ask the class, do you think it is wise for company to borrow money? Let me hear from you. Do you think companies should use debt finance to fund its business? Yes, Biola.
Good evening, sir. So, based on what you've said this evening, it is necessary we balance both the debt and equity so that we won't have to go through all the disadvantage of the two. So I mean that you have to balance your debt and equity ratio to fund your business, sir. That's my take.
So before you go now, how do we balance it? Should we do 50% equity, 50% debt, or 40% equity, 40% debt, 60% debt?
So it all depends on what is available. For example, if the interests are low, you know that you have to borrow more money because the interest is very low at that point in time. But if it is the equity, probably the market is doing very well. You know that at that point in time, you have to go for equity. So the balancing is just the main thing here, sir. Thank you.
All right, thank you for the contribution. Shola? Yes, Shola, you can unmute. Talk to us. I can't hear you. Can anybody hear Shola speaking?
No, I can't hear Shola.
No,
No,
sir.
sir.
I can't hear you, Shola.
So Shola, we can't hear you. It's unfortunate. Maybe you are speaking, we don't know, but we cannot hear you. Yes, Moses, what's your view?
Good evening, sir. I think
Yeah, good evening.
just like Biola said, we need to balance it. But for me, I'll prefer debts because you get to enjoy some tax incentives when you go for more of debt. Let's say 60% of debt to
All right.
finance your
All right, thank you. Moses said yes that although there is need to balance it, but it is better to finance our business with more of debt capital so as to take advantage of tax benefits. That's good. Now the question is, will your choice of capital structure affect your value or not? This is the question these theories are trying to explain. If I finance my business and equity, will it affect my value as a company? If I finance my business with equity and capital, will this increase my value or reduce my value or leave my value unchanged? Yes, Chioma, is noted. Your contribution is noted. So the question we are trying to treat now is, do you think the choice of capital structure will affect value of the company? Let's go to this discussion. There are two theories that attempted to explain the impact of changes in gearing, the impact of changes in gearing on the weighted average cost of capital and on share value. There are two main theories that try to explain how changes in capital structure can affect share value and cost of capital. These theories are one. Okay. The traditional theory of capital structure. And we have two, Modigliani and Miller theory of capital structure. These are the two main theories of capital structure. We have the traditional theory of capital structure. The traditional theory of capital structure, we also call, when we say capital structure, it's also called gearing structure. The traditional theory of capital structure is of the view that there's an optimum level of gearing for a company. The traditional view of capital structure, the traditional theory of capital structure is of the opinion that there's an optimum level of gearing for a company. This is the level of gearing at which the weighted average cost of capital is minimized. According to this theory, according to the traditional theory, the optimum level of capital structure, the optimum level of gearing is that level of gearing that minimizes your weighted average cost of capital. That is, companies allowed to borrow money. Companies allowed to increase its gearing, borrow more money. As your gearing increases, as the level of borrowing increases, if you borrow more money, cost of equity will rise. Immediately you start borrowing money, the shareholders will demand additional return. Hence, cost of equity will rise. However, the cost of debt will continue to fall. The more you borrow money, the more the cost of equity increases, the more the cost of debt falls. In your capital structure, there is greater proportion of debt capital. debt capital is cheaper. So the more you borrow money, your cost of equity is rising, your cost of debt is falling. Your weighted average cost of capital will continue to fall up to a certain level of gearing. The WACC continue to fall until the WACC reaches the minimum. Once your weighted average cost of capital get to the minimum point, then the company has achieved optimal level of gearing. I'm coming, Chibuzo. The optimal level of gearing, the optimum capital structure is that capital structure that minimizes your cost and maximizes your value. The optimum capital structure that minimizes your value. So according to the traditional theory, your choice of capital will affect your value. How you choose to finance your business will have impacts on the value of the business. You must choose wisely. Once you achieve optimal level of gearing, then your work will be at minimum. At that point, you must not introduce gearing again to the business. Once your work is at minimum points, you must stop introducing gearing. Yes, Chibuzo.
Okay, sir. I wanted you to give a scenario that one can compare this to,
Chibuzo,
because you
please, can you
mentioned that.
unmute?
Sir, I'm unmuted. Can you hear me?
Okay, please go ahead.
Okay, I wanted you to give a live scenario to what you mentioned, like something we can use to understand. Because you said as your debt increases, your cost of equity, as your debt increases, your cost of equity increases. But I want to, I don't know how to like match that. Is there a way you can help me here to make me understand better? Maybe you can use a business scenario.
Yes, let's go back to that question. Yes, Chibuzo.
I said that regarding what you said, that as your debt increases, the cost of equity increases. Can you give us a scenario using a business? Like, let me understand how that implies.
Ah,
Because I also believe
nice
that if your
scenario.
debt is increasing, if your debt is increasing, it would, if your debt is increasing, this will probably affect your profit, right? It might, it might.
Chibuzo,
Mhm.
save yourself the stress. If you borrow more money, if you introduce debt to your business, that means you are bringing in financial risk. That means the company risk will increase. If the risk increases, the owner of the business will demand additional compensation. What determines returns is a function of your risk. Assuming you finance your business with equity only, that means you are only exposed to business risk. You are only exposed to one risk, business risk. As soon as Your company borrows money. Your company has introduced financial risk to the business. That means the shareholders will be exposed to both business risk and financial risk. As soon as gaining increases, that means level of risk has increased. In that case, the investors will expect additional return to compensate them for the higher risk. That additional returns to shareholder will increase cost of equity. When you say cost of equity, that is the return to equity holder. To the company is a cost. To the investor is the return. So, you know, you are just starting cost of capital computation. Try to follow the class. You are going to observe that the more you bring in debt, the more cost of equity increase. Try to follow Juwon's class. You are going to observe that as debt increases, cost of equity will rise, cost of debt will fall. The overall cost of capital, WACC, will fall. That is what the traditional theory is saying. That by borrowing more money, we know that cost of equity will rise, but cost of debt will continue to fall. Up to a certain level, your weighted average cost of capital will continue to fall until it reaches the minimum point. Once the minimum point is achieved, that is the optimal level of gearing. In summary, the traditional theory is saying that the choice of capital structure decision will affect value of the company. That is the conclusion of the traditional school. How you choose to finance your business will affect your value as a company. Is relevant. Oh, is it gone again? Or is back? All right, let's go on. So, Chief Buzo, the more you borrow money, the more your cost of capital goes up. The more your cost of equity rises. Number two theory. We have just like 30 minutes. Modigliani and Miller theory. Modigliani and Miller theory. Without taxation. Assuming there is no taxation. Modigliani and Miller developed a capital structure model. Modigliani and Miller developed a capital structure model to challenge let me take that again. Modigliani and Miller developed a capital structure model to challenge the position of the traditional theory. They argue that the choice of capital structure decision will not affect value of the company. Modigliani and Miller argues that the choice of capital structure decision will not affect value of the company. According to M&M, the level of gearing will have no effect on the value of company. Your level of gearing does not affect your value. If you like, finance your business with equity. If you like, finance your business with debt. If you like, finance your business with equity and debt. In whatever ratio. If you like, the company can choose to finance with equity. Or you can choose to finance with debt. Or you can choose to finance with equity and debt in whatever percentage. This will not affect value of the company. This is the position of Modigliani and Miller. This is the theory of Modigliani and Miller. They argue that provided there is no taxation, M&M theory was based on the assumption that there is no taxation. In as much as there is no taxation, a company can choose to finance its business with equity or finance your business with debt or finance your business with equity and debt. This will not affect value of a company. Hence, Modigliani and Miller reached the conclusion that where there is no tax, Modigliani and Miller come to the conclusion that where there is no taxation, the level of gearing, the choice of capital structure is not relevant to the value of the company. There is nothing optimal level of capital structure. That a company does not need to bother about optimal level of gearing. You can choose to finance your business anyhow. This will not affect your value. According to M&M, as the level of gearing increases, Let's go on with the class. And we are almost through with the class. So according to Modigliani and Miller, as the level of gearing increases, there is greater proportion of cheaper debt capital in the capital structure of the firm. The cost of equity will rise. The cost of debt will fall. The weighted average cost of capital remain unchanged. If cost of equity increase by 5%, cost of debt will fall by 5%. Weighted average cost of capital remain the same. Provided there is no taxation. The weighted average cost of capital is the same at all levels of gearing. Inasmuch as the work is the same, value of the company will be the same, regardless of the level of financial gearing. In other words, level of financial gearing will not affect value of the company. That is the conclusion of the traditional school. Sorry, that is the conclusion of Modigliani and Miller without taxation, on the assumption that there is no taxation. Modigliani and Miller arguments, ignoring taxation, can be summarized as two propositions. Let's go to this. Look at the proposition 1. The weighted average cost of capital in a geared company is the same as the weighted average cost of capital in an ungeared company. The work is the same. Look at mathematics here. Weighted average cost of capital of geared is equal to weighted average cost of capital of ungeared. Inasmuch as the cost of capital is the same, value of the company will be the same. Value of a geared company, VG, is equal to value of an ungeared company. Proposition 2. The cost of equity in a geared company is higher than the cost of equity in an ungeared company. If a company is geared, your cost no wonder it's raining heavily outside. I didn't even know. Let's try to round up. Proposition 2. The cost of equity in a geared company is higher than the cost of equity in an ungeared company. The cost of equity in a geared company is equal to the cost of equity of an ungeared company plus financial risk premium. Look at the calculation. Look at the formula here. KEG, cost of equity of geared, is equal to cost of equity of ungeared. You can't see my screen.
Not showing, sir.
It is network. Can you see it now?
No, sir.
No.
Cannot see it.
So we have to wait. He's trying to load it. Is it there now?
Yes, you can see it now.
This is what I'm explaining. The cost of equity in the GS company is higher than the cost of equity in an GS company. KEG, cost of equity of geared, is equal to us, open a bracket, KG, cost of debt, close your bracket, multiply by value of debt over value of equity. You are going to use right. In the next 10 minutes, I think I should be done. You are going to use Modigliani and Miller theory without tax if you are not giving tax rate in the question. Let me advise you sincerely, don't ever cut a class off. What told you next week, the network will be bad. It's raining, we won't stop the class. Those are variables not within your control. We are not going to come to this lecture again for this topic. Otherwise, we'll be there for 1 month, doing one topic. We just try to manage the situation. Can you see my screen now? Hello?
Yes, we can see it, sir.
Yes, we can see it, sir.
All right. So if you are dealing with without tax, you use the formula above. Now to round up, No. We have Modigliani and Miller with taxation. Modigliani and Miller, their first theory is without tax, and they concluded that gearing is irrelevant. Udo, please can you, Daniel, please can you mute? The first theory, Modigliani and Miller without taxation. It was concluded that the choice of capital structure is not relevant to company's value. However, Modigliani and Miller later revised their model. Modigliani and Miller revised their initial model to include corporate taxation. The inclusion of corporate taxation significantly changed their analysis. The inclusion changed their analysis with corporate taxation. Interest on debt capital is a liable expense. With corporate tax, the interest on debt capital will enjoy tax relief. Therefore, Modigliani and Miller argue that where there is taxation, value of a geared company will be higher than the value of an ungeared company. Where there is taxation, value of a geared company is higher than the value of an ungeared company. This is because the geared company will enjoy tax relief. A geared company, a tax relief will be used to reduce cost of capital of the geared company. Reduction in the cost of capital of the geared company will increase the value of a geared company. Look at the logic. If you borrow to finance your business, you are going to enjoy tax relief. That means your business is geared. When you borrow money to finance your business, that means your business is a geared business. You are going to enjoy tax relief, tax benefits, tax shield on debt capital. This tax relief will be used to reduce your cost of capital. Reduction in your cost of capital will increase value of your company. Emmanuel Modigliani and Miller argues that where there is taxation, the level of gearing, your choice of capital structure will affect value of your company. Modigliani and Miller concluded that where there is taxation, where companies are liable to pay tax, it is better to finance your business with more of debt capital. By taking debt capital, you are going to enjoy tax relief. The tax relief will be used to reduce your cost of capital. That means the cost of capital of a geared company is lower than the cost of capital of an ungeared company. When we say cost of capital, that is weighted average cost of capital. That is the overall cost of capital. If the work is lower, value, if your cost is reduced, your value will increase. Modigliani and Miller therefore reached the conclusion that because of tax relief on interest, there's an optimal level of gearing that companies should try to achieve. A company should try to make its gearing as high as possible to the maximum practicable level in order to maximize its value. That is, borrow as much as possible up to the maximum level of borrowing so as to reduce your cost of capital and maximizes your value. Modigliani and Miller arguments with corporate taxation can be summarized as two propositions. Proposition 1. The weighted average cost of capital in a geared company is lower than the work in an ungeared company. An ungeared company is also called all equity finance company, all equity company. So the work is lower in a geared company. Look at it. Weighted average cost of capital of geared is equal to work of ungeared multiplied by, this is bracket. This is a big bracket. One minus dt, value of debt multiplied by tax over value of debt plus value of equity. The formula will be adjusted like this. Total value of a geared company is greater than the total value of an ungeared company. Total value of a geared company is equal to total value of an ungeared company plus the value of the tax shield. Look at the equation here. Value of a geared is equal to value of ungeared plus debt value multiplied by the tax rate. This is the tax rate. Finally, the cost of equity in a geared company is higher than the cost of equity in an ungeared company. Look at the formula here. Cost of equity of geared is equal to cost of equity of ungeared plus 1 minus the tax rate plus bracket 1 minus the tax rate multiplied by bracket cost of equity of ungeared minus cost of debt, close the bracket, multiplied by value of debt over value of equity. We are going to apply this formula. If the company is paying tax, all right, let's do a summary. We are done with the explanation. A summary, what we discuss, we look at capital, the money you can use to finance your business, to run your business, to expand your business, to create your business. Type of capital, equity capital, debt capital. Your capital structure shows the various type of capital you have used to run your business. Your capital structure shows the mixture of equity and debt capital used to finance the business. You can finance your business with equity or with debt or with a combination of equity and debt. How you choose to finance your business will affect your risk. We now discuss risk. Risk is volatility in your returns. When your investment is unstable, your investment value is fluctuating. Under it, we discuss business risk and financial risk. We explain that your business risk, nature of your business, your financial risk, because you have borrowed money, that gives rise to financial risk. We now look at gearing, your gearing level, the leverage, the extent to which a company has borrowed money. Under this, we discuss financial gearing. Financial gearing is used to measure level of business risk. We look at operating gearing. Operating gearing is used to measure, financial gearing is used to measure level of financial risk. Your financial gearing is used to measure level of financial risk. Your operating gearing is used to measure level of business risk. We look at the factors affecting choice of capital structure. We now discuss the theories. Modigliani and Miller theory without taxation. We discuss Modigliani and Miller theory with taxation. All right. Of course, we can't take any question tonight, but you can look at this question. This was the question texted November diet 2025. How the first diet. Look at the question. Critically discuss why different companies might choose to adopt different levels of financial gearing, even within the same industry. This is discussed for, this question was texted why do companies choose to adopt different levels of financial gearing, even companies within the same industry? Look at Zenith Bank. Look at Guarantee Trust Bank. These two companies, they are in the same banking sector, yet they have different levels of financial gearing. Why? What the examiner is asking you technically is factors that determine capital structure. What the examiner is technically asking you is, what are the factors that determine the choice of capital structure? Your choice of capital structure will determine your level of financial gearing. You can look at it. Look at it. Look at the solution. Differences in business risks and earnings volatility. Asset structure and collateral availability. Growth opportunities and investment strategy. Appetite and strategic philosophy. Ownership structure and control consideration. Task position. All right, please. Excuse me. After the class, we shall share this material with the platform. You are encouraged, when you get the material, first, download the material and save on your laptop. Let me tell you this. After the lecture, some will now be asking for, please, can you share again? Let me be factual with you. Download this material, save it on your desktop, and maybe you are going to label each lecture. As exam gets closer, nobody will have time to be giving anybody any material. All right? Any question? Clarification? Before we step out of the classroom? All right, may God give us a better understanding. I will be checking out of the classroom. Let's have a blessed evening. Good night.
Good night, sir.